the next video. Now we're going to look at volume rule number 2. And this one is basically the opposite of volume rule number 1. Again, volume rule number 1 is very simple. We want volume to increase when price is moving in the direction of the trend. We want volume to decrease when price is consolidating or retracing against the trend. Now, it only makes sense, therefore, that if volume is doing the opposite of those things, that is not confirming that price move, and therefore that price move may be in jeopardy. So let's take a little look at what we've got going on here. So let's go back here. Price comes above the moving averages. You got a cluster of moving averages here. Price goes above, up, 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 long half cycle. Okay, it's supported by some big volume. Nice volume spike there, nice volume spike there. This one pushes through the moving averages. This one keeps it going. And we get one more here, but this one's a little lower. Okay, again. And so that actually ends up being the cycle high. It comes back down, makes the cycle low. During that retrace here, we get a retrace in volume. Now, we get a little half cycle here that goes nowhere. Get another little half cycle that makes a little bit of a higher high, but doesn't really go too far. Volume does not increase, although you've got, decent volume. So volume's continuing to support the move up, but it's not showing an increase. And as I say, price isn't really moving too much, but it's making a little bit of a higher high. Okay, on this move down here, let's move down here. You get a little bit of a volume retrace, and then a nice trend line can be formed right here. And sure enough, we make a nice little higher high. That one's a little bit more of a significant move. Now look at what happens there. Can you see it? Look at volume. The next step that happens in volume is whoosh, way down. But what is price doing? Price is still moving up and making a higher high, and that's another half cycle up. So this is a very dramatic difference from anything that's happened over here on the left-hand side of the chart. And this is very important, by the way, as just a general principle of trading. You want to not just hold certain pictures in your mind about trading from books and so forth, but you want to look at the chart you're trading and look at the history, especially the recent history, and look for things that really stand out on that chart. Well, this really stands out. Look at that minuscule volume, how deep it goes. And it's just a very clear decline in volume as price moves up. So that is a warning, number one, but also it's important, again, that by itself, maybe not that important, maybe it's a seasonal thing, but it's also in an extended trend, right? We're late in the trend. So that combined with the timing of the trend means this could be a very nice reversal trade. Then, as we come back down on that half cycle, volume, boom, explodes back up. So huge dramatic difference there. It really stands out. Okay, let's move our chart to the right because I have some very interesting things to show you here. We need to move it even further. Okay. So here's where we were looking before. There's that dramatic move down in volume on this higher high. Okay, so we get a cycle low, or a half cycle coming down. Volume is back up. Now we get a move back up in price. What's volume doing? Well, volume is pretty much the same, basically, isn't it? we would want a retrace to be on lower volume, but we're not getting that. What about the next move? So we got this move down, we got this move up. What about this next move down? Right, what's happening there? Well, actually, volume's actually decreasing a little bit there. That's not too encouraging. We put in a lower low, but volume, it's not dramatically falling to zero like this, but it is getting, it's going down. So then that makes us worry a little bit. Then we get another move up. Well, this move up turns to be a pretty big move up. In fact, what we really have is a megaphone pattern. So we make a lower low and a higher high. So we get a nice big move up. But what happens? Volume still continues to go down a little bit. So now we're thinking, now what in the world is going on here? We took a short up here. It started out good. Volume came back into the market. Our retrace, though, volume stayed about the same. The move down, well, volume roughly the same. Maybe went down a little bit, which was worrisome. Then we get a big retrace, put in a higher high, but on lower volume. This is crazy. Volume's all over the place. It's doing everything wrong. But price is going up, so shouldn't volume be going up? But it's not. Well, let's continue to look. So price puts in another higher high. You get a little cycle there. And then it comes back down. So now volume should be retracing and going down, right? Well, it's not. In fact, it's actually increasing a little bit. Now we go make a higher high. Is volume going up? Well, not really. In fact, truth be known, let's clear up my messy chart here. If you really look at the overall pattern here, this whole time, volume's pretty much just in a rectangle. You get your little declines, your little inclines, but nothing dramatic. And the truth is, it's all kind of range bound in this rectangle that I've drawn. And so it's not giving any clear signals. Well, there's two things I want to say about this. Number one is, again, as I shared in the first video, this is one reason why I don't use volume on every single trade, is because it doesn't give clear signals on every trade. In fact, a lot of trades it really doesn't. It's somewhat ambiguous or late. Sometimes it's early. Sometimes it is a leading, quote, indicator, if you will, even though it's not an indicator in and of itself, but sometimes it indicates what's going to happen to price on an early basis. But there's one more thing, and I'm going to give you a second to think about this one, because if you can figure this out, then you win the top dog prize of the day. Can you look at that chart? This is your quiz. Look at that chart and think of any reason why it would make absolutely perfect sense for volume to basically be range bound during that whole time, and why really it's not a surprise that volume doesn't make any marked higher highs, that it's just staying in that rectangle for all that time. Feel free to pause the video and think it over if you'd like, but I'm going to give you the answer right now, so if you want more time, better pause. Look what else is happening this whole time. A little clue here. That red line is that 50 period moving average, and it is just going sideways that whole time. And so that's the point. Even though price goes down, makes a lower low here, and then makes a little higher high, higher low, higher high, you will have some traditionalists who will say, gosh, that's an uptrend now, because by definition we have a higher high, higher low. It's an uptrend. But overall, the intermediate trend in volume and our 50 MA is saying, no, that's no trend at all. That's just noise. Wouldn't worry about it. It's not going to last. Okay, just very, very temporary. And this is the beautiful thing. When the 50 MA goes flat, we say we have no trend. So this short that we took over here, well, that really did not work. Okay, we wouldn't have lost money on it with good money management. We'd probably pick up a few dollars. But it didn't work in the sense that we take the short in order to get the reversal, a downtrend. Well, we didn't get a downtrend. The trend ended, so that part worked. But then the market just went into consolidation for a long, long time. This is a daily chart, so that's a long time, months. And so it just went into consolidation, and therefore there's no significant volume signals because there's no significant pressure of supply and demand. There's no major supply-demand imbalance to push this market one way or the other. So it's just kind of biding its time and volume staying pretty even because the trend is sideways, or actually more accurate, I should say, there is no trend. Now, let's look at what happens here. Finally, the market does, in fact, we can even go forward a little bit here. Okay. Finally, the market does go into another downtrend. And when it does, look what happens. Boom, there's your down move, and boom, there's your volume spike. It gets above this rectangle. And so finally, the market's able to push above that. And with the volumes able to push above the rectangle, market's able to really make a, start a directional movement here. Okay, let's go on to our next rule. Okay, volume rule number 3 is that a dramatic spike in volume can be an exhaustion signal. Now, again, one of the common errors of looking at this for many retail traders is that they think these exhaustion signals, again, are long-term signals. That, okay, we have found the bottom in the market for the next 20 years. Well, that's not the way it works. All these volume signals are worth about a half cycle or a cycle, and that's it. But they do very well with that. In addition, it's good to look for, if you're familiar with candlestick patterns, and I don't use a lot of candlestick patterns, but I do use candlesticks on my charts, as you know, and I use kind of a Barry Burns simplified candlestick system, which we'll teach in another course. But you can, find candlestick courses and books all over the place. There's very good material out there, so there's no need for me to duplicate it because it's already very well documented. And in fact, even on the internet, just Google candlesticks and you'll find those primary candlestick patterns for free on the internet. So for that reason, I don't feel there's any need for me to go ahead and teach you all of that. But let's look at some basic things here. So here we've got, again, our increase in volume. We've got a volume spike. Okay, you can see that spike in volume. Don't you love my art? Okay, cycle low and a nice little hammer pattern there. I just call that a spike bottom reversal bar. And so these kind of bars can mark cycle highs and lows very well. And when that bar, so that bar is in and of itself a potential cycle low signal, but then when you combine it with the spike in volume, again, it's another confirmation of that. Okay, volume comes down, comes back up again, cycle low, volume spike, and again, that's an engulfing pattern right there. So you've got the real body of the green candle engulfing the real body of the red candle. That's a very good, I like these 2-bar patterns very much. So again, both of these are excellent signals for cycle bottoms. So these again are things you can look for confirmation when you say, okay, well, I see my cycle lows here on my indicator, but I'd like some extra confirmation. Well, of course, we look for all 5 energies, but you can also look for candlestick patterns and these volume spikes. Now, like everything else, the more confirmation you look for, the less you're going to get it, less frequently you're going to get it. The market is not interested in handing you money on a silver platter, believe me. I think you already know that. So it's not, if you adapt your trading rules and your methodology so that you are requiring a lot of confirmation before you enter a trade, well, that's good, and it should increase the win-loss ratio of your trading, but it will lower the number of trades you get. And that's not necessarily a bad thing. That might be the best thing you ever do in your life, as long as you can concentrate and focus and not miss those trades. So look for these volume spikes. They happen all over the place. Even right there. We'll look at a couple more here.